Welcome to the Real Advisor Podcast, TRAP, TRAP. Please follow us and join in the conversation on Twitter @Advisor Podcast, where you can suggest ideas and themes you'd like the TRAP team to discuss. Also remember to like and subscribe to our YouTube channel and leave a 6 out of 5-star review on iTunes. Doing all this really helps us, which means we can do more to help you. Now let's head over to the studio for the latest pile of TRAP.
Yes, indeed, dear trappers. Welcome back to episode 83 of the Real Advisor Podcast, TRAP, TRAP. My name is indeed Lick Lincoln, and joining me as ever in the digital studio of doom are the three other horsemen of the apocalypse. Carl, the voice, the Lavocci Widger, Annie, Ultra Heart, and Alan, the storyteller Smith. Now, gentlemen, we have a show packed full of absolutely nothing. So let's start unpacking it straight away with some more high-energy review read out by my very good friend, the Right Honourable Mr. Andrew Ursane Hart.
Thank you very much, Nicholas. The first review has been left on Podcast Addict, 5 stars, Chris Sindens. I'm not an IFA yet, but as someone with an interest in financial planning and investments, I've been listening to TRAP for over a year, including the back episodes. A mix of discussion, information, and mostly good-natured banter, together with various recommendations for listening and reading from the TRAP team, has persuaded me that I should proceed to the next stage in my journey. So I'm now studying RO1 and RO6 with a view to joining the industry. Keep up the good work, guys.
Oh, what a way to start the show. Fantastic.
And my final review is from James Oak Private Wealth, entitled Bloody Good Show. I've been a financial planner for 29 years, but I've learned lots from this podcast. They may be irascible, look it up boys, irreverent and opinionated, but most importantly, they are passionate, unapologetic and fun. I don't agree with the twaddle they talk about annuities, IKEA wardrobes, and Jesus wept. I'll never thank Nick for the month of my life I lost to Atlas Shrugged. But I'm so glad I found this podcast and I've recommended it to many others. Keep going, chaps. You're awesome. Bit of a mixed bag there, but we'll take the 2 5 stars. Thank you very much. Back
I'm sure
to
you've
you,
read that one out before.
I've
read that before.
That sounds very familiar to me, that second one.
I don't mind reading it out again and again.
That's a good one. Yeah, we'll read that out every week. By the way, Andy, quick question before we carry on. So the first one was on, what'd you say, Podcast Addict?
Oh, yeah, Podcast Addict. Yes.
So how are you trawling through all the platforms? Well, that's a lesser-known one, isn't it?
Yeah, I've got a sort of link that shows me all of them, but sometimes it's a bit jumbled in terms of when they're left. But we've got enough now, but please do keep them coming. It adds to the ratings. We've got 228 on Apple, which is the main thing. I think we're 4.7 on average, which is superb. But yeah, please do keep them coming in.
A couple of ones which dragged us down a bit, but
that's nice. We like
hey ho.
Yeah, it's the same site, isn't it? Raphonic.com. I've got this up here, which collates all the reviews from the various podcast apps. So thank God it does, because it's very hard otherwise to see what's going on. Okay, yes. Moving on then. Let's put a timestamp on episode 83 with some 83. Jesus Christ. 166 weeks. Topical Titbits for episode 83. Kicking off with Ultra. This is going to be a recurring theme, not just in this episode, but I think over the coming months. Kick it off, young man.
Yes, so I got an email from Standard Life, and I was just scrolling through it, as I normally do, and I picked up this news story. So Standard Life introducing private assets to their managed funds. A quick point on this. You've mentioned it before, Nick. People divert their own funds and can choose the funds. But this was the thing that I picked up on. These managed funds, managed portfolios, which are huge, you don't get to choose the underlying asset allocation. Hence, the large investment houses can make these decisions. So this is the first of many decisions introducing assets that may or may not be wanted or required within certain client portfolios. But anyway, so Standard Life introducing private assets to their managed funds. I think they're in partnership, following from the link, with Schroders, who have a huge fund called Future Growth Capital. So that's part of the Schroders stable. Apparently there's 77 billion market cap currently. And they said to the clients, or they said to the advisors, there's going to be no change to the fees, the annual management charge. However, the performance fee will apply to the private asset allocation element. 20% charge. They have given themselves a hurdle, but again, I don't really know the detail. But they're basically saying we're going to charge 20% on any growth over 5.9%. And they've got an example of it. I don't know if that 5.9% is per annum, but anyway, this is quite big news. And they're only initially going to be allocating a small amount of the fund to it. I think it's 2.5%, ratcheting up to 5%. The assets that it's generally being exposed to are private equity, real estate, private debt, which is something that is bubbling at the moment, and venture capital. So quite an interesting story, I think, from Standard Life. I'm sure the other large asset managers may follow suit, certainly if there is a nice lumpy performance bonus. But yeah, that's Standard Life being quite transparent, actually, with advisors and the clients. But yeah, over to you boys to discuss. Remember, we have the put your hand up system.
It'll be interesting to see how the other insurance companies follow suit.
Yes.
The Scottish Widows have gone out on a limb, as said initially, sod you, we're not doing this. However, if Standard Life and XYZ Life
Royal
Insurance
London,
picks up,
Aviva, Legal in General.
picks up loads of money, we'll see if they stand by their principles. But you know my views on this. This is a disaster waiting to happen. And there's another good reason not to use managed funds, and there's already a litany of those in existence. I don't know who's next with the hands raised.
Alan.
You can tell. It's me. We talk about this pretty much every week, and probably one of the reasons we talk about it because it's in the news every week. This is a classic, retail asset managers sort of bounding in after the horse has bolted. We've talked about it often. I think I've specifically talked about this. I've certainly posted something on. I think I posted on LinkedIn, but about this specific fund. Schroders are all over this, and they see retail as an opportunity. So they've come in. The fee structure is it is complex. It's complicated, and they've got hurdle rates, and above a certain thing. But it's just not designed for the average client or the average financial planner. I mean, if their hurdle rate is, what do you say, 5.6, for example,
5.9,
5.9, that doesn't seem particularly high. In order to beat that, long-term public equity market returns would be higher than that. I would have thought the only reason you'd want to allocate to this is you're anticipating a higher return than you get from public market equities, predominantly. So, and then when you tie in I don't know whether liquidity is an issue for them, additional costs, it doesn't seem.
Well, it always is. It always is.
It doesn't seem appropriate. And here's the thing, not that I'm an expert in any way, but I know I do, and I think you do, Andy, to an extent as well. I kind of follow the trails of private equity and VC investments in the US. Listen to All In podcasts, for example, every week. Not that that's an expert, but it does give you a flavor for how the real experts over in Silicon Valley and the VC world are thinking about this stuff. And the general theme is this was a great place to be for the 10, 15 years when interest rates were zero. You can raise money at practically zero and you can invest in it and all sorts of things. Those days are gone. And that's the general theme from the experts. And now, as often is the case, that's drying up. They can't raise money anymore. They can't invest to the same degree. So they think, where else is the opportunity? I know there's trillions invested in retail investment accounts, pension funds, etc. Let's go after this. They don't know any better. We'll pile in.
Yeah.
But based on a 10 or 15-year historical track record that is unlikely to, frankly, ever be repeated. So the message from us, I think, is the same as it always has been, which is best avoid it. Carl?
Yeah, you absolutely nailed it. I had 3 points to make, and you mentioned two of them. So, first of all, the long-term average returns of the stock market is greater than what their hurdle rate is. So, I think their hurdle rate is kind of low. I guess the argument there would be, you're diversifying and markets are high, blah, blah, blah. Number one. Number two, if you're tapping up the retail market for liquidity, it means you've run out of road elsewhere. You can't get it elsewhere because it's much, much easier and much, much tidier getting it in big lumps from institutional investors, etc. And the third point I was going to make, and I don't know the answer to this, but if you have a managed fund, whether it's Standard Life or any other company that has a managed fund, are there not kind of, is there not like a memo on arts, or kind of here's what we can invest in, and now all of a sudden switching to something like, oh, we're just going to bring in, private equity. Is that not a bit strange? Is there no kind of protections for the consumer, for the investor around, well, traditionally a managed fund is going to be equities and bonds, right? So this is a big change. Like what's next? Is cryptocurrency next, and we're just going to
Maybe,
leave it there?
This would fall under that,
of the
though.
fund.
But this is equities and bonds, but it's just different. So when I've ever looked at these things, these sort of investment thesis and agreements, they're intentionally kept very broad.
Yeah. 300 pages
The
long.
important thing is liquidity. Could you, because in these funds, people are moving money in and out all the time. Can I just, if I want to, can I just sell my fund and get all my money out tomorrow? That's the key thing. And that's where a number of funds have got unstuck in the past, particularly as we know, property funds and a bunch of others. And everything is fine. Everyone's moving around until the music stops. You try to get your money out of this. If there's a serious correction coming up, public markets struggle. So private markets, where you've got to get access to that liquidity, they need to sell assets. These are private companies, or they are private credit, private debt. These are businesses which owe you money. You say, well, I want to get it back because I've got now, $1 billion of withdrawals being requested.
Yeah, exactly.
Liquidity will dry up. So the devil's in the detail. It'll be interesting to know what their liquidity, because as I say, property was the classic example in the past. Bricks and mortar property funds, they all got gated. People couldn't get the money out, in some cases for years.
Yeah.
And they're nearly
exactly
all gone.
my point.
They're nearly all gone.
Why introduce something like this into a traditional managed fund where people have an expectation of, I know it's money.
Incentives drives behaviour, I was going to say.
Money.
But these...
Sorry, Andy. Final point. For a company that's kind of traditionally very conservative, Standard Life, I would have thought, certainly in the Irish market, that would be the way I would view them. It seems like a kind of a very innovative move. Shall we just say it like that?
but surely
brave,
unnecessary. I can't imagine that their investor, their clients, are knocking the door down saying the only thing that's wrong with this portfolio is I can't get access to private credit instruments.
Private assets are the flavour of the month. The previous one ESG has died down. They're just finding something new. They're a marketing business, not a financial planning advice business. These 4 asset areas are certainly not going away. Private equity is going nowhere. Real estate's going nowhere. Private debt will run into some issues, and venture's always been here. These 4 areas are huge at the moment, and they'll be huge going forward. That doesn't mean that we will be putting any of our clients' life savings in it, but these 4 areas are not going anywhere. It's not as if they've run out of money elsewhere. They'll be constantly getting topped up. So, we'll have to.
That's true. That's a different point.
And wait till you hear later on. But Nick is going to talk about the private credit stuff. So anyway,
cool.
Our work will never be done.
Next point is, I'm going to talk about it later on. I understand it vaguely. Smithy, magazine covers.
Well, this I think follows on quite neatly from what we've just been talking about. I think all advisors, we have clients who refer to a newspaper or a magazine article, and it will be very pro or very against a particular theme or investment or structure. And you might get sent it, and your client might say, "What do you think about this? This journalist has written this thing." And the more going back a few months, it was all about gold, wasn't it? Why haven't we got gold in our portfolios? This magazine, this Economist article says that gold is the best thing since sliced bread. And there's one I got recently was actually they've moved on from gold. It's now silver. Silver's got all the attributes of gold, but the price is far more depressed, and therefore the potential upside is significantly greater, et cetera, et cetera. Now we have this all our lives. So I came across a really an interesting piece of research which was done. It was done a couple of years ago, but it compared and contrasted front page articles in The Economist and Time magazine. And they looked at all the ones, obviously there's a lot of neutral, a lot of not specific, but the ones that had come out either strongly for or strongly against a particular asset class, and, you name them. And then they would go on to track, 6 months, 1 year, 2 years, 3 years afterwards, how that asset class performed. And it's an absolute contra indicator. If the magazine says buy silver, for example, That is the time, if you own it, to sell silver. And I've posted a link to the article in the show notes, because I just think it's quite useful when clients call you up and say, I've just read this, this is what we should be doing. Say, hang on a minute, based on some historical track record of magazine articles, I think we should do the opposite. There's, the chances are we're probably going to do better than what they say. Interesting.
Wasn't Sam Bankman-Fried Time Person of the Year, and then a year later?
That's a whole other one. There's a brilliant one. I think it's Fortune magazine. Top superstars under 30 or under 35 or something, and you name it. Bankman-Fried's in it. What do you
Elizabeth
call that?
Holmes.
Yeah, she's in it.
Yeah.
I mean, every one of them. Most of them are.
You don't want the title.
Long sentences.
When you get the email, we've earmarked you as the Time Person of the Year, Alan Smith. You're like, do you know what? You can keep that.
That is a direct indicator. But the other one are, as they say, contra indicators. If the magazine says it's a great time to invest, it's not. If the magazine says it's a great time to sell, then fill your boots and buy it. That's the history. But it's useful just to refer clients to that and just say, this article may be correct. Who knows? But based on some historical other magazine articles, it's unlikely to be.
I would say for our younger Trappists who maybe haven't heard of this one, the most famous example I've got of that of magazines is, of course, the Business Week one from the 13th of August 1979. Yeah. And the Business Week cover was The Death of Equities. This is the US magazine. Yeah. And it was saying the stock market is over, inflation's killed equity, the equity premium is gone. This was just over 2 and a bit years before the greatest bull run in American equities in history. So if you've taken that at face value, that's an absolute classic. And I would suggest if you get emails from clients where they're referring you to content, to stuff in the media, to magazines, you can find images of that. It's so on the internet, so many images of that Business Week article from 1979. Just copy that, stick it back in the email. Don't even say anything, and just shove it down their throats. Would be my way of doing it. Carl, your hand's raised, but I think it's just through inertia rather than you actually want to say something.
Yeah, correct.
just picking up on that point you mentioned, Nick. I, in my younger years, have experienced that. I'm sure others on the podcast have. Has it changed? What I mean by this is there used to just be the Sunday Money section, whereas now everyone is just inundated everywhere you look with different publications, everything online, a billion different opinions. So now it's just overload and clients don't really know what to focus on. But it used to be a very common thing. Advisors wake up on a Monday morning, open their inbox, and they've got 5 emails from clients saying, this is in the mail on Sunday, this is in the FT, this is what should I do?
Yeah.
Whereas we've sort of moved on from that now. Clients send us a WhatsApp link to some Grant Cardone Daily Mail article about silver.
The news feed now is a constant drip. As you said, it used to be like a cadence of a Sundays. You'd read the Sunday Times money section, or the comic section, as I called it, just to be aware of the filth that was entering the minds of our clients. So we were kind of on the front foot when they phoned up about it on Monday or Tuesday. But it's just constant drip.
He's correct. He's the other thing. First of all, it's constant. But this is played
in into our hands now.
Yeah, up to a point. There is
we don't get it as much now because they'll read one article at 9 a.m. in the morning saying buy silver, then they'll read an article at 5 a.m. saying sell silver. So they think, do you know what? I'm just gonna not bother contacting Andy. It's a wider subject. Nick mentioned it for the younger advisor. I didn't lower my hand, guys. Anyway, right, Alan, you can speak now. For God's sake.
Thank you. I was just going to make another obvious point. There's other studies which have been done which say it's just news in general, positive news versus negative news, and the weight of negative news versus positive is like 95-5 or something. And why is that? Because again, you've got to remember the business that the publication is in, whether it's a website, a newspaper, a magazine. They're there to get downloads, clicks, eyeballs, because the model is an advertising model. It's not. Back in the day, you used to buy a newspaper, walk down the high street, and physically hand your money across and get a newspaper. And there was less necessity to capture your attention in that second. But now, all those models have moved across to an advertising, or not the vast majority of them. So they need to capture attention really quickly. And what we know is the human psyche, the way that the brain operates, is that we pay attention to drama and to danger and to negativity. If the front page says everything's good, a globally diversified portfolio of equities is still good as it was last week. No one's buying, no one's interested, no one's clicking the advertising. So that's another underlying theme here. The predominant sort of quality of the news or type of news and headlines are going to be negative and sensationalist, because that is the business model that exists.
Okay, right. We're 20 minutes in. We've done 2 topical tidbits. So, Wodge, be careful of AI.
Yeah, just very quickly, I've attached the link. There's a 6-minute YouTube video about Deloitte in Australia were commissioned to do a report for the Department of Employment. And somebody in Deloitte, it seems, popped it into ChatGPT and just reproduced the report. And it was found that the report had references, footnotes, names of books, names of authors that were either incorrect or just did not exist.
Full of errors.
So a big furore in Australia about this. Deloitte had charged 440,000 Australian dollars for the report. Whoa. And they had to only refund the last batch, which I think was about $90,000 or something like that. But look, everybody is... even I'm using AI these days, right? ChatGPT, etc. You just got to be really careful. And kind of following on from the last point there, knowledge is, or information is everywhere, but wisdom. is much harder to come by, and that's where we can excel, and that's what we should be using AI for.
Absolutely.
So look, just be very careful in what you produce, if it's all being produced via ChatGPT or something similar. And look, not to get too morbid about any of this stuff, but there's a really sad story in the news at the moment about ChatGPT giving answers back to somebody, and it was like an echo chamber, and that was a young person, and that story did not end well at all. And I would say no more about it, but it's just be careful of AI, of ChatGPT and the likes, because... they're echo chambers and they'll just churn stuff out. So just be careful.
So I'm being thick here. Were Deloitte's, was their report based, they were quoting things that weren't exist, or did AI? Yes. Right, so AI did AI picked them apart then, did a good thing?
No.
AI,
they were asked to do
I watched the video, Carl. I know it's
charged $450,000, Nick, and they produced the report, but they used assistance via AI, but AI bollocksed it up, but then they still issued the report to the client. The client went through it and found
said something like,
Thank you.
As XYZ author said in her book, blah, blah, blah. And she goes, hang on.
Yeah, we got it.
I've never read that book.
So the likes of governments now going forward are going to all have, insist in the terms and conditions that you disclose your usage of AI when you're bringing in consultants to do reports. And look, I suppose it's the whole innovation versus integrity. And is there a clash there? I think if you use it properly, there's not. But if you're just, saying, hey, ChatGPT, create this report for me, and then you're charging 440,000.
Yeah, that's wrong, man. That's wrong.
Has that done significant damage to Deloitte's reputation? Certainly in Australia, I bet it has. And the fact that
they're just the canary in the coal mine, aren't they? Everyone's up to it, but they're the first ones to get caught.
Yeah, but they shouldn't have done it. That's at the base of all this. It was just wrong what they did.
Very quick check your work and make sure it's bang on.
Well, this is the thing. I was drafting a newsletter article for our clients, and I pop it into ChatGPT just to check, make sure everything is okay, embellish it or add to it, whatever. And I put into it how many words. This was this morning. How many words is this? And I could have just done it on Word or Google, but it was in ChatGPT. How many words? And it says very confidently, this is 742 words, which is the kind of optimum size to capture attention and to keep people reading to the end. I thought, that is true, but it looks shorter than 742 words. So I just said again, are you sure? Can you check again? And I went, oh, whoops, my bad. It literally says my bad. ChatGPT. It said, no, it's 336 words. It's like completely different number. Just because I intuitively knew just by looking at it it was shorter than they're saying otherwise.
It was like it was in a rush to move on to something else. It was
give me a better question.
Let me deal with your question seriously, Alan. Just on that, I'm using Grok way more than ChatGPT now. I go to both of them and ask the question to both. It's staggering the different answers that come back, which should just be data on the internet. So I'm way leaning towards Grok, which is Elon's AI company.
I've tried both, and it depends. And those two plus Perplexity for more deep research seems to me to be the better ones.
But use two. Use two is
moving on. Okay. All right.
Interesting.
Okay, hand lowered, please, Alan. Ooh. And now a quick word from her indoors.
And now a word from our sponsors.
We love doing this podcast, and we want to involve as many trappists in the conversation as we can, which means growing our audience. To do that, we've partnered with a little-known startup called Vanguard, an investment manager that we really like and whose values strongly resonate with ours. Vanguard pioneered low-cost, diversified investment portfolios and now, through their Advisor Alpha framework, they're 100% aligned with the Trap community in helping advisors demonstrate the value of financial advice. So, thank you and welcome to Vanguard, who are sponsoring Trap to help us extend our reach to include more advisors in the conversation.
There we go. Exciting times with Trap and the Trappists and our audience and Vanguard and Nicola and the team there, who we've got a load of time for. Leading nicely into, Wodge, this superb survey that Vanguard have just done.
Yeah, it is kind of cool. The Vanguard Advice Survey 2025. I think this is their first version. I could be wrong, but I think it is a comprehensive report, and it's a survey based on answers from over 1,000 advised clients and 200 financial advisors. So this is a significant amount of people with various answers coming through. And I suppose the big kind of news from this is what advisors think the clients want versus what the clients value and want. There's a little bit of a disconnect there, and Advisor Alpha, the way you'll see loads of marketing about, if you have an advisor, you're going to get more than 3% a year. The clients think it's actually much more than that, which is very interesting. But there's kind of two things that I honed in on from the report. Now, the report is 17 pages long. I would encourage everybody to go and download it. There is a link in the show notes to do exactly that. The things that the clients really value are the trust that they have built up with their advisor. Now, if we link back to gold or silver or sending in magazine articles or whatever, once you build up this trust, they actually will follow the advice, and they become much more comfortable that they're going to be able to retire comfortably, that they're not going to run out of money, that kind of stuff. But also then they really do value the behavioral coaching. Now, I thought this was really interesting, that the calming them down conversations when there is market volatility. And we've spoken a lot that really, we've been 15, 16 years into very little market volatility that's of a prolonged nature. So, but yet this is going to be talking to Trump tariffs, COVID, all that kind of stuff. So they really do value that. And look, the check-ins as well that clients want versus what advisors think. Like Nick, I don't know, did you read it in detail?
Yeah,
clients they do like the face-to-face, and they probably do want more check-ins than we actually give them, which is interesting. And I don't think if you drill down into some of the survey answers, it's not necessarily full review meetings they're looking for. It's just a check-in. Are you okay? Everything all right? Haven't spoken to you in a while. And for me, I was only talking to my own team about this morning, and I was saying, guys, this could be we have the pod structures that we've spoken about. It could be anybody in the pod. Just pick up the phone. Hey, we haven't been in touch in a while. Yeah, everything okay? Is there anything on your mind? Anything we need to do? And as I said to my own team this morning, I said, the vast majority of the time they'll say, no, all good. But I really appreciate the call. And that's how trust is built. And that's how you'll find people won't necessarily be bringing, gold versus silver, or pushing back on advice. They'll tend to, I trust this person, I trust this advisor, I'm going to go with his or her advice. And you can't do that in one meeting, as we know. That's done over time. But yeah, really, really good report, really good survey. And I like the fact that they've identified this disconnect, because really what we think doesn't matter. It's what do the clients think. Anyway, over to you guys.
Yeah, 6 of one, half a dozen of the other on this. Our value is from the behavioural coaching side of things and stopping clients from making the big mistake. And I think having meetings for their own sake, or having meetings set by the clients, we're not here to give them what they want. We're here to give them what they need. And part of our behavioural coaching is not inundating them with meetings, not inundating them with messages about the markets and so forth. So I'm quite glad there is a disconnect, because we're the advisors. We're the doctors dispensing the medicine, and they're the patients. If they knew exactly what they needed, they maybe wouldn't come to us. So that's no problem with that. I thought a couple of other things I took out from the report that are quite interesting. This is a quote from the report. The most common reason that investors end their relationship with an advisor is not poor investment outcomes. It is a neglected relationship. Amen to that. And I totally get that. I think that's the most reason why complaints come in from clients. It's not because they necessarily feel they've been given particularly bad advice, is because they feel unloved and neglected. But what's interesting, that quote wasn't from the clients, it was from advisors. According to the survey, 24% of advisors cited a neglected relationship as the primary reason their clients disengaged with their service. Very odd for advice. I wouldn't admit to that. I'd love to know, I hope it's not in the report because I've scoured it. I'd love to know what
I think that
clients
24% came from clients, Nick. That 24% came from clients. That 24% came from clients.
No, 20% of advisors cited a neglection. They don't quote the clients if they were asked, and that's what. Secondly, poor investment returns was the second most cited reason for clients walking away. And as you alluded to, Carl, 16% of advisors said that clients walked away because of poor investment returns. I'm thinking this is the golden age. I mean, Jesus Christ, they're walking away now because of poor investment returns. God help us when we get the next prolonged temporary decline. But yeah, very interesting point. Of course, very, very well put together. They're really on top of this stuff. The Advisor Alpha stuff's been going now, since 2008, 9? It's a long time, and they're just building on it all the time. Who's Smithy?
Yeah, just to frame this was Vanguard surveyed. It says over 1,000 advised investors and 200 financial advisors. So it's a reasonable sample set. You do get sort of themes and trends when you start speaking to 1,000 plus people doing it. Yeah, and just to put a number on that as well, the Vanguard Historical Advisor Alpha, and candidly, I think I have and others have questioned a couple of points on that in the past in terms of putting a number on behavioral coaching and what have you, because it's hard to put a number on it. But as I think Carl said, this doesn't really matter what we think, is what the client thinks, what the client's perception is. And the data is that 94% of investors say their advisor adds value, estimating an average 6.5% to put a number on it. So clients in general, if you ask them how much additional investment return do you get through behavioral coaching, asset allocation, et cetera, that's the perceived number, 6.5% a year. Interesting feedback. The key theme throughout this, and it doesn't come as a huge surprise, really, but the key theme is it's all about trust. People need to trust their advisor. They need to trust them at the outset, trust them on an ongoing basis. And how do you create and retain trust? It is front of mind. I hear what you say, Nick. I hear what you say, that give clients what they need, not necessarily what they want. But in any relationship, in any professional relationship, personal relationship, within reason, if you see people and engage human to human a little bit more, then that tends to add another deposit in the trust bank, bottom line. If the default is, which seems to be in UK and Ireland financial planning right now, we default to one annual planning meeting, which in your case, Nick, as you told us, about 20 minutes. And maybe that's a blessing. Maybe it's not. But often these are 2 hours a year. It doesn't feel like a huge investment in the long-term trust bank. I know they're getting newsletters and updates and what have you, but I just think, and they do refer within the piece as well about leveraging technology outsourcing investment solutions, so you're not spending half your life building investment portfolios. And obviously Vanguard have got a very elegant outsourced solution in terms of their life strategy, etc. But the whole point there is creating more time. And the question is, what do you do with the time? Well, if you can create a little bit more face time, and whether that moves from an annual full fat financial planning annual planning meeting, plus every 6 months a check-in, a quick Zoom call, a quick Teams call, just touching base, seeing how you're doing. And that is literally a 20-minute, 5-10-minute call. That's not a bad thing. Clients are saying that. The clients that were surveyed, Nick, are saying we would prefer that. We don't see our advisor quite enough. And by the way, the interim meeting isn't all the other stuff. It's more of a, how are you? What's going on?
Yeah, I can give a good example of that. Our company solicitor, I haven't had any reason to speak to him in a good while, and I met him at an event, and he went, "Hey, we haven't met up in a while. Let's have lunch." And we sat down, we had lunch, and he was going to Orlando with his kids, and I had done that, and we basically chatted over lunch about exactly that trip. So there was very little or no work discussed, but it definitely forged the bond stronger. And if I ever need a company solicitor, it'll be harder. It would be more difficult for me to even consider anybody else. So look, these touch points, they do matter. And this report has just told us that.
Just to confirm, Carl, listeners can click the link in the show notes, and if they have an account with Vanguard, they can download this. If they don't, they just set up a quick account and they can download it. That's what I'm looking at. Client Connect.
Super. So I did it right today.
Right?
Okay,
yeah,
great
so.
content.
Yeah, so there's a link in the show notes. Right, onwards. What's next?
Onwards
Alan.
next is, very quick one on this one, Smithy. SJP's new charges.
And be careful, make sure you get it right. You're
Yeah,
muted.
I didn't start speaking though, to be fair. I noticed I was unmuted. I was muted. Now I'm unmuted. Anyway,
content.
It is a quick one. We have been tracking the fate of the mighty St. James's Place for several years on this podcast now, from the high highs to the low lows of last year when the share price collapsed and everything went kind of wrong for them for a bit. And it was going to go one of two ways. They were either going to sort of go into oblivion, or they're going to make a heroic return to success. And it looks like it's the latter. Their numbers more recently are incredible. Their sort of new assets in the last quarter just reported are at a record-breaking level, and they're flying again. They've gone through a very painful process, but specifically what I noted, their new pricing charging structure, which I don't think is quite out yet, but it's imminent, is extremely competitive because you can now access low-cost index funds. And of course, with their scale, I can't remember, is it State Street or one of the huge like institutional... Is it State Street? So they have got a deal with State Street paying, pennies. So the whole thing now for advice and custody, tax wrappers, etc., and investment, if you use a low-cost index funds, the figure quoted that I saw was 1.27%. Now that's punchy in terms of a composite. If you're doing proper financial planning and tax structuring advice and investment management and everything else, so all of a sudden, the company that were always pointed to as being, they're crazy, so expensive, no one's going to pay that. They're now seriously credible. If price is your only differentiator, they're now competing with the best, any of us, quite frankly. I thought that's quite interesting. So their fortunes be interesting to track over the next year or two.
The bulk of the detractors did focus on price, but obviously SJP is huge. Their famous in-house fund range is called Polaris Active, which are slightly higher fees. These are now their Polaris passives, keep it simple. And insiders, advisors that work there, they're delighted about this. They're telling me, Andy, this is great news. And they're saying it's going to be interesting to see the performance differentiation between the Polaris Active and the Polaris, passive. And I'm like, I'm pretty sure I know how this story is going to end. However long you push this time frame out, the passive funds should, I wouldn't put my life on it, but I'm almost close to.
They will.
Massively
I'll put your life on it.
The active funds. It's a pure maths. It's a pure maths Excel problem. But we will see. But yeah, it's pretty competitive, all-in ongoing fee for a human advisor.
Yeah, bloody brilliant company. I said it way back. This is going to trigger so many people.
Oh, yes.
We
just lost another 10 Trappists.
If you remember back, I said when the share price collapsed, I said they are taking the pain, they are making changes, they're doing the hard stuff.
They went up front with it, yeah.
And they did. They just went straight out. They held their hands up and said, "We're doing this, this, and this." And I said, if I was an investor, I would buy their share now. They're a fantastic company, and now all the people who said, "Oh, they're so dear," that's the only reason not to invest with them. Let's hear how they changed their tune.
So
the
final point here has got to be, so therefore, if, as often happens in mature industries and professions, if price no longer is a differentiator, and frankly, if you want to hire a London lawyer, one isn't 3 times the price of the other without good reason. They all sort of congregate around a certain price. So they're now congregating around the sort of the pricing of the independent sector. So, as should always happen, the focus should be on what you get for your money. Do you get comprehensive, full-fat financial planning, behavioral coaching? What sort of experience? Because that's a differentiator. If you're just getting pension consolidation, switching funds around for the same price, then it's bullshit. So all of a sudden, we're in the world now where everyone's competing on what they actually deliver and the value they deliver to their clients, which is a good thing for clients and for investors.
Yeah, it's a good point, Alan. The whole industry over time, I think, is going to accelerate a lot quicker now to full-fat financial planning and focusing on the behavioural coaching. It's good news for end consumers. Great stuff. Nick.
Just hope you got the 1.27 correct. Otherwise, there'll be a deluge coming our way.
It can be lower. They've got a fund at 0.09%. It's staggering. An international equity fund.
Okay.
Anyway, sorry, Nick.
Thank you. So moving on from the invulnerable SJP to vulnerable clients, and just forgive me for this one. I've got to spend a few moments just setting the picture on this one. I've got a client who I've known. He's been a client since 2002, 2003ish, and he came with me to Values Division when I set up in 2008. He was like a seed client. I needed a handful of clients to come with me with the ongoing trail commission just to make my business, just so I could have some cash coming in the early days. And he was the CEO of 2 big, proper blue chip PLC companies in his time. He was a big thing. He was a big thing in the city, and he was a non-exec on the boards of other big brands. And he was someone who was once a thing and was listened to. And now he's 88. He's living at home, nice home in the home counties. His wife has got dementia. He's effectively a carer for his wife. He's still got most of his faculties, but he's bored witless. No one cares anymore what he thinks about anything in terms of business. His time is gone, but he's struggling to adapt to this. So I don't look after all this client's wealth. He's got money with a well-known wealth manager / DFM. I never know quite what the crossover is, but you know the kind of people I'm talking about. The posh brigade. And I'm now getting these emails from this client. Let's call him Derek. I'm getting these emails around. So the other day I was at my desk at 6:30 in the morning. There was already an email from Derek in my inbox saying, "Nick, I want to move £5 million from my GIA over to your low-cost evidence-based portfolios with the platform that he's been on since forever." Because over time he's realised that posh DFM just can't, as you alluded to there, Andy, it's just a spreadsheet thing. Over time, it's really difficult for posh DFM to keep up with a low-cost evidence-based equity portfolio. So I get this email thinking, Christ on a bike, he wants to move 5 million. He's 88 years old for a start. I don't really want to be taking money off an 88-year-old. I don't care how compass mentis they are. From a GIA, which means an enormous capital gains tax situation, and I'm getting more of these emails from him. So what I've done, and this is where it gets a bit hazy with vulnerable clients, because we've all got a duty of care, not because the legislation says we have to, it's because it's baked into us, right? Because our clients are our income. We've got a duty of care to these kind of clients. And so what I've done is 2 of his sons are also clients of mine, and the younger one, David, I've kind of brought him in now. And I said, listen, when Dad sends me an email like this, I'm going to forward it on to you, okay? And then we're going to triage it. You're going to go round to your dad's house, go through his emails and pretend to see this email you've sent to Nick. And then we're going to have a 3-way conversation about it and sort of massage your dad out of that decision, which I think is a very bad decision. Now, obviously, because the dad is a proud man, okay? And he wouldn't be overly happy if he knew that I was sharing emails with his son. And I'm sure this breaches all kinds of GDPR stuff. I'm sure it breaches all kind of data confidentiality things. But that's what I'm doing now. And this is how I'm managing this client. So I just wanted to know how the Trap Pack would deal with this kind of thing and how the Trappists deal with it. Because by the book, I'm sure I'm not supposed to be sending client emails from one client to another, despite the fact they're blood and strong blood. It's a very tight family. And also, just to tie a bow on this, I told the platform that the client's on, in this case it's Transact, but I'm sure any fit for purpose modern platform, the Transact, the fundaments, they'd all be the same. I sent a security email to Transact saying, listen, Derek is showing signs of, he's just acting a little irrational. He's sending out these emails now that are out of the blue and kind of just knock me for six. He never normally contacts you direct, Transact, but if he does in future, can you please bear in mind to contact me? And to their credit, on their website, on the client profile section, Transact have a vulnerable client box. And if that's ticked, they'll put in there exactly what you tell the client and what the situation is. So I log on now and I can see that for Derek, they put all these things down. He's liable to send these emails. He's bored. He's a bit depressed, blah, blah, blah. And now anyone at Transact can see that as well. So credit to them. It's a really slick way of doing it. So I imagine there are compliance people out there thinking, oh my God, Nick, you cannot do this. You cannot involve a third party without the client. Yeah, maybe I can't technically. You tell me a better way to take care of my clients than doing that. What are your thoughts, guys?
Right. So this is a classic example of where you're actually breaching the regulations in order to do good by your client. That's the reality. Candidly, Nick, you have breached all sorts of rules there, client confidentiality, GDPR, etc., by sharing confidential information shared by a client with you with a third party who happens to be a relative, in this case his son. But you've done it with the right intentions. You've done absolutely the right thing. So you're between a rock and a hard place, because the alternative is you don't do anything at all because of that. Let the whole thing just sort of roll on and let whatever happens. And then you'll be criticized for that as well. Overall, you've done the right thing. We've had similar situations in the past, particularly when people are elderly, and it was an elderly mum, I remember a few years ago. We just picked up the phone, spoke to daughter in this case, and just said, this is what's going on. What do you think we should do? How are we going to navigate this? It's really tricky, and this is why you can't put everything in a box and say, this is what we do, this is what we don't do. There is no black and white answer. Every situation is different, but I'm inclined sometimes just to pick up the phone and get some honest feedback from the family members and say, how would you think? And obviously document that, because they may say, no, Dad's fine. As far as I know, Dad's absolutely fine. Please crack on with his instructions. Because ultimately this, what do you do if someone who hasn't been medically diagnosed as having dementia or anything else gives you a formal instruction as a client? Do you literally just say, I'm not going to do it?
So you've got to self-destructive. But yeah,
but what you said there isn't necessarily self-destructive. It's not obviously. If it was, I want to take the money out and give it. I've met a new 21-year-old Russian girl. I'd like to send the money to her.
Alan. He's bored witless, and we're all living.
Well, maybe he wants to see you a bit more often, Nick, as was previously discussed in the Vanguard.
I saw him last year in November, and with his son. Actually, all three of us went for a meal. So it was a human. I mean, I was sat here having my pot noodle, but they were in a different part of the Zoom thing having their pot noodle. No, we had a meal together. And but we're all getting older. We know this, right? But so our bodies are getting older and lasting longer, but our brains, I think, are still deteriorating at the same rate. They haven't been upgraded. So the bodies are going on for another 10, 15 years, but the brain's still degrading at the same rate it has done for the last 2,000 years. So this is going to become more and more of a problem. And I would just like to know how so you've mentioned you do pretty much the same sometimes when you have to, Alan. The son, by the way, is so grateful for this. He's got he's all over
I'm sure.
Because you act with integrity when no one is looking, right? Now, obviously, everyone is looking now because you've just announced it on the podcast, right? But no, this is the point. That life is not black and white, and there's grey. All the time there is grey. You didn't do anything wrong at all, it would be my view. I think you could say on a technicality you breached GDPR. Surely there are times when GDPR just has to be breached, and you have done the right thing by your client. You're also doing great stuff for your own business, I would say, because that son is going to be a client of yours till the day you die, and he will refer other people into you because you've done the right thing. And I think the crucial part of all this is that the client was trying to move the 5 million to you and not away from you. So like this is more proof, if anybody who wants to take you up on a technicality, that you did the right thing. I think this is, doing the right thing. This is what we should. This kind of stuff is the stuff we should be talking about all the time on this podcast, because
Great,
this
thank
is
you.
why we started this podcast. We didn't start this podcast for you guys to bitch about Rachel Reeves every single episode, right? Or me to talk about PRSAs and the tech. We didn't. But we've
the real issues. Yeah,
this is and this is what, if you're doing your job right, and you're doing right by all of your clients all of the time, you will do something like this. We had something similar enough, Nick. It's kind of very recent experience for us, so I won't go into the details. And we did exactly what you did. We involved his grown-up son. But like, bravo, my friend, and you know, to say it when you're kind of going, technically, maybe I'm in breach, and to say it here, because hopefully, if we can get one other person, one other advisor somewhere to do exactly what you've done, right? Well, now we're on the road to a profession and not an industry. Now
Lovely.
we are
Thank you,
doing
Carl.
the
I
right
appreciate
thing by
that.
our clients.
Thank you, matey. Ultra.
I mean, I echo exactly what these guys have said. And obviously, you're struggling with this because you're in the thick of it now, and it's ongoing. So it's going to be tough with you and the family to try and work out what's what. You went for lunch with the client and the son. I mean, surely you got collective permission. So whenever I have a situation where I'm dealing with mum or dad and sons involved, I'd get clear permission from the mum and dad. Am I okay to discuss everything openly with XYZ son, etc.? That's the first question. Did you get that? Is that something?
Well,
it
was kind of tacit. It was kind of tacit. You know, when we finished the lunch by saying that, Dad, Derek, you know, I'd like David to be at these lunches going forward, if that's okay, because I think he needs to be.
And am I okay to discuss everything with him?
Yeah. Kind of that. But I never said, oh, and by the way, if you send me an email at 5:30 in the morning,
I get it.
Forward it on. So it wasn't that blunt.
But just from the behaviour, it's quite clear that they all want everyone to be involved. And my next point is, did you call the client immediately when you're getting these weird emails? I'd call the client immediately. Call the client. Did you?
I immediately forwarded the email on to his son and said, I've had this from your dad. It was 6:30 in the morning. He might have gone back to bed. He's 88. I don't know. He's caring for his wife with dementia. I don't know what the situation is. But I forwarded it on to the son and said, can we have a chat this morning? I've got this from your dad.
Okay, you reacted immediately.
Yeah,
you reacted immediately.
Yeah.
I would have called them and discussed it quite at length, and I would have got permission then for them to speak to their son and children. Yeah, I've had various things with clients over the years. Immediately, I'd refer them to call the sons and daughters, and but me and you think very much
the power
alike,
of attorney
Nick.
thing. If you got power of attorney,
is that in place? Is there an LPA in place via the son? That's the next step, or not?
They have got all that. Okay. But it's this pride thing, you know. It's this. We all know as people get older, they want to give away less and less and less, and they get more stubborn and set in their ways. And this guy was once a high flying captain of industry, and I think it's just a pride thing, you know. Anyway, so I think we've given that a good thank you for your input.
Yeah, just go and have another lunch. Go and have another lunch with the son and the dad. And you know, get it implied then. So anyway, cool. Fair play. That's brave.
But I think
bringing
from the behaviour
up.
of the family, it's clear that they're happy for things to be discussed, Nick. So that's in your favour.
Yeah, and they're uber tight. They're all, even though they're moneyed, they're not money. You know, some moneyed families have loads of underlying issues, and I don't. As much as I can know anybody, I've known these people for 20 years. They don't have that. They are very simpatico with each other. They're looking out for mum and dad, and then it cascades off that. Okay, and by the way, Trappist, if you want to comment on this or any subject that we comment on, we put these episodes out on X. We put the episodes out on our LinkedIn track page. There's not often quite a good commentary section on there, the list, comment chain on there. So do comment, do add in, because it's always nice to know what you are doing out there as well, Andy.
So just on that point, Nick, we've upped our game, haven't we? Now we've got partners. We need to grow up. So we've got a new contact us page on our website. Our website is therealadvisorpodcast.com and we have a contact us page on there. So please do go there, therealadvisorpodcast.com. It's in the show notes links. Fill in the contact us section, which is at the bottom of the page. Okay, it's over to me now, Nick, is it? So
it is, sir.
Bring the energy around. Minor point, first of all. Humans Under Management, which is next Thursday. It's that time of year again.
Is it?
I am in London.
No,
and
it's Wednesday, isn't it?
Next Wednesday.
Hey!
Sorry, I had bloody.
You got
trap
corrected by
watch. So on the
biggest day of this year.
God, you were thinking, God, Andy, I'm planning on the wrong day. I'm going to
12
miss
months.
Yes, so Humans Under Management London, you are hearing this on Thursday. It's the following Wednesday. It's Wednesday, the 12th of November. I am fully sold out now. 450 of you
Well done.
awesome humans will
Amazing.
be there. These boys will be there. It's been a huge amount of increased work switching venue. I won't bore you with it. Very excited to put on a great show.
Okay.
So hopefully we're going to see lots of the Trappists there. And there's lots of aligned brands. We've got an evening gig as well, by the way, 5 till 10, music, cocktails, drinks, all going ahead. Okay, so on to my next point. This is the Berkshire Hathaway Q3 earnings. It sounds incredibly dull, but I think there's a lot that we can take from this. Have you boys seen this latest article?
No, tell us more.
Funnily enough. No, I did see it in the news.
Let's just talk about it. Berkshire is sitting on an insane amount
Carl's
of
left.
cash assets. 381 billion. It's the highest cash position they have ever had. But most importantly, just to get some indicators here, he's a net seller of the great companies of the world. So he sold more great companies than he bought. He's done no share buybacks, which is what he's famous for, which he believes still at a slightly declined price. His own company is not worth buying, and he's holding more cash than he's ever held before. I am 100% invested 100% at the time. Obviously, Buffett has a different remit, and it's very interesting all the numbers. And it's very interesting all the numbers and the revenue that Berkshire Hathaway bought in. It bought in 95 billion last quarter with a net profit of 30 billion, but a huge amount of that 30 billion, 21 billion has come from investment gains. So have you boys seen this? You boys not interested in this?
Not interested.
Yeah, Andy,
like reading these articles.
Yep. I saw it. And of course, the headline of all these things is that because in the last quarter, as you're right, he sold another load, I don't know how many billion of stock in the last quarter. Hence, he's now sitting on the highest, the biggest cash pile ever. So naturally, everyone's thinking, well, he is the greatest living investor.
He thinks the market's punchy and choppy, too high.
What is this a serious indicator? And I don't know. This is what the hell do I know? Nothing. But I just think that it's like the world. Things is a transition that's going on. His whole philosophy is of the kind of the complete the value stock, long term buying, generally buy and hold value, undervalued stocks, etc. Hold them forever. Traditional industries, businesses, American Express, Coca-Cola. Apple, if he wasn't for buying Apple, his returns wouldn't have been anything as good as they are. But if you look right now, it's a bit like, it reminds me a little bit of our conversation. And I'm conscious of not being, this time it's different. But, maybe the world is slowly changing. Our conversation before about there was a time to invest in venture and private equity. If you look at the returns, he's basically invested in US businesses. If you look at the returns, as we know, the Mag 7 are driving 90% of the returns. The S&P 493 basically flatline over the last several years. He is by definition outside of the Nvidias, the Microsofts and what have you. He's not participating in that. Maybe he's playing a different game. I mean, did you see as well, Nvidia have gone through 5 trillion market cap. I mean, it's just, and so those organizations, because this is just a huge bet on the future, which is basically an AI play, and who knows, maybe it will all come off, maybe it will all generate the returns that the markets are saying are justified. But Berkshire Hathaway is clearly outside of that bubble right now, and maybe over the long term, if things do correct. He was also outside of the tech bubble in the 1999, 2000, etc., and then so he significantly underperformed the S&P around that time, and then when that crashed, he recovered. So I don't know. Is this a sort of generational shift in that Buffett is clearly extraordinary in terms of his investment, but has the world moved on?
He's basically sitting on 40% of his assets in Berkshire Hathaway in cash. It's incredibly conservative. He's always wanted to have a cash buffer, but when you've got a cash buffer of $100 billion, do you need more?
Well, this is the thing.
I know he's probably thinking that as a percentage, but
he's had a big
$400 billion
buffer
in a few months. Yeah. But years ago, he had $1 billion. Then it was 10 billion.
but
then it was 50,
so
it was
even
100.
in the last
381 billion.
Yeah, but he's had like 200 billion for a couple of years or something now. And in the meantime, obviously, what have the markets done? Driven by the Mag 7, they've absolutely powered ahead. So he has given up that return in markets generally by sitting in cash. I mean, it's a brave play. I wouldn't bet against him, but it is interesting what's going on with them right now.
Okay, guys, I'm just conscious that we're now literally an hour in, and we've still got one topical tidbit to go, and that'll be.
You can skip it.
Sorry, Carl.
You can skip it if you want. Nick.
On a crossroads. This is. We've been waiting for this.
Let's dig into this one. This is a negative story about Ireland. The first in a few months.
PRSA corner.
No.
Well, it's not PRSA corner. It was based on. There's going to be a bit of a theme here. An article that was written by John Collison of Stripe for the Irish Times. And I was also at the Dublin Chamber annual dinner, and the president of the Dublin Chamber, a guy called Owen Quigley, did a brilliant talk on what we need to support Irish business. On the premise that, well, maybe these huge corporations, US corporations, and the tax take we have is going to come to an end. So we probably need to foster some, kind of startups here and look after ourselves.
Disrupt yourself.
Almost. And it's like, what's that phrase that I was just trying to think about while I was talking there? The best time to fix the roof.
Fix the roof when the sun's shining. Yeah.
Right. Because we are look, every list you look at the moment, Ireland is like, it's all happy days, right? But there are creaks, there are cracks, and in terms of we don't have enough homes for ourselves. Our infrastructure is sadly lacking, and there's lots of reasons for that, and it's a lot of it is around quangos, that kind of stuff. The Collison article is brilliant because it calls it out, and the politicians have all kind of went, that's food for thought. That's very interesting, because they can't diss him because he's not a politician, and he is this hugely respected businessman who's made good over in the States. So. Look, I think this is the kind of conversation we need to be having. It is to challenge each other and to make. Can we make this wealth that we have created sustainable? There's loads of things we need to do, but in order to do that, we do need to make some hard decisions or take some hard decisions. I just think the more of this kind of stuff that's challenging. Will kind of make people sit up and go, okay, this is actually real, and we need to do some things now whilst we have the opportunity to do it. So just very interesting, and I will talk about John Collison again in a little while. So the theme...
Have you got, Carl, is there a new, I don't know, we called president, prime minister, just recently? I was reading about president, I was reading about her. I suspect that Nick Lincoln may not share her views. Her and Nick Lincoln don't read the same books. By what I read, perhaps,
possibly. But anyway, I don't like talking about politics, as you know, so I'm not going to know.
Atlas Shrugged. Has she read that one?
Perhaps, I don't know.
Okay, right.
Carl shrugged.
Enough. Draw a line under it. A line. 63 minutes in, episode 83 of the award-winning Real Advisor podcast, the award-winning and now proudly sponsored by Vanguard, and there's another sponsorship lurking in the background. We can't wait to talk about that as well, but we're going to talk about it in due course when it's all nailed down. So let's move on to now what many people call the meat and potatoes of the show. This is where we take a subject and basically, without any preparation, talk around it for about 15 minutes. So obviously things are happening with Trap. We've had it's just been great. We've loved it. We've had a great response from our audience. We love our audience. You're so involved. We think we're adding significant value to the advice community, and we're making a real change. That might sound a bit vainglorious, but I just have to go with what I see and the reactions that we get and the comments we get and the stuff coming into us all the time. And so we're looking to take Trap forward to the next degree. And no, it's not because they're looking to monetize it. This was always the plan. No, it's not that at all. But we put a heck of a lot of stuff into these shows. We give a heck of a lot away for free. And we want to make sure that when we're doing that, yes, we get some compensation for it, but also that we do it in a structured manner so that you get the very best of what we have to offer, and we can take the very best from you as well and distill it back. And there are various ways that we can do this, obviously with the tech and so forth going forward. Yes, we've got the sponsorship from Vanguard. That's going to be brilliant, by the way. We haven't really talked about what that involves, but there's going to be content, videos, and so forth coming through Vanguard and Trap, which is going to be super exciting. We've got a day's filming coming up in London. God help Vanguard. What else can we be doing? So each of us now are going to take an idea. We're going to put it out to the audience. And Andy's going to talk under me.
We can also mention our other partner is Fundment. But
we didn't need to, did we? We didn't need to. We just didn't need to do it.
But our two partners are now Vanguard and Fundment, just to get that in.
And they'll be delighted that we all get on so well together and we never argue or dispute live on the recording.
So well.
And our other partner clearly is Humans Under Management.
Yeah.
No, the other
have you
two,
got a retirement event coming up soon, Carl?
Nope, I do not.
Are you hiring?
Not right now.
Not yet. Okay.
No.
Anyway,
have you got another podcast, Alan?
I have. Fantastic. Great.
Okay, by the way,
this
is great.
Bulletproof Entrepreneur, you do need to sign up for my next episode going out next week. Incredible.
Love it.
Back into the matter of the day, because if I just follow on from Nick, and you're right, the origin story, for those that didn't listen to the first couple of episodes, came about from the four of us being on a walking trip, hiking in Ireland 3 years ago. And we all ended up in a restaurant sitting around talking about our industry, our profession, good, bad, and ugly. And then we all said this would make a good podcast. And everything was a mini experiment. Let's launch. Let's do 3 episodes. See what the feedback is. It will probably die on its feet. Won't get any further. But it didn't, and it's done nothing other than grow. And it's grown and it's grown. And you're right, as Nick's just said, we are clearly one way or another adding some value, because we all get inbound. We get DMs, emails, WhatsApps, connections from whole people. I had one this morning. Quick side one. Young lady who wants to go out on her own. She's been working for this other financial planning business, wants to go out on her own, bit of feedback. So there is things going on. There are movements. So the point of this is we've all been chatting online and offline, the four of us, about what should we do now? Where do we take it from here? Do we want to really kind of double down? Do we want to create more value for this community? Do we want to carry on as we are? We even thought, should we just jack it in? It's achieved everything we wanted to. And we've gone through all those conversations, and we've concluded that no, we want to grow this because we enjoy it, it's good fun, and we know that from the feedback that we get that we are helping people, and people are making decisions, and people are connecting with each other. So we now have a bit of funding behind us, so we can be a bit more serious and sensible about this. And so there's an entire range of things that we can do. What we want to be clear is we're always going to have a significant part of our content for free. It's going to be out there. The podcasts generally, the past episodes, 82, 83 now, past episodes are out there. They're available. Within those, there are some absolute gems of wisdom. You might have to look quite hard, but there are some good comments, some good insights, some good, ideas and suggestions for anyone working in our profession. But what else do we want to do? The way that I see these things, and I've bought lots of programs and developments myself over the years, and there's a natural kind of hierarchy that goes from free content, download, knock yourself out, YouTube, etc. It's all there. And the next one up, I suppose, and maybe Nick wants to sort of explain this in a bit more detail, the idea of having an online digital community, right? So where we can add some content, we can post video there. We can invite people into it. Now, that obviously takes more time. Just even registering for these things and these some digital platforms costs money. So this would be a paid-for service at some level. It's designed not to kind of break the bank of the community, but it's the next level up. Nick, this is more. We were kicking around the idea of the Trap Academy. Why don't you say a bit more about our thoughts on the Trap Academy?
Well, okay. So, yeah. I mean, you said a lot of it there, really. So one of the thoughts we had was that there are these subscription models now, and the tech is there where we can build a really nice online modular course for the Trappists, where you take it at your own pace. There'll be a series of videos, how-to scripts, experiences, There'll be an active area for members of Trap Academy to communicate with each other, channels and so forth. So it's not Slack or anything like that. It's a proper platform as a learning resource, a paid for monthly subscription amount. We don't know what it would be or what have you, but I think that'll be as an initial entry point, just to get a bit more from Trap and to engender a greater sense of community. It wouldn't be a massive outlay. And there are other things that the other Trap packs will talk about that will have perhaps more of an investment, more of a tuition fee involved. But just having an online community where we can offer you guys regular content, constantly updated in a modular format. You take it at your own pace. We could have Q&A sessions for sure. Maybe one of the Trap packs sits in every month. Or you haven't really scanned it out, but it's there. I'm quite keen on that because that appeals to how I like to learn. So I'm probably projecting my own value system on that, but that's something I'd like to pursue, and I think it's something that especially the younger Trappists will get a lot of value from. But even at the start of the show, when Andy read out the review, well, the guy who's been advising for 29 years finds value in the nonsense that we knock out. So that's what I'm leaning towards, and I'm quite happy to sort of run with that on behalf of the Trap Pack initially, and to build something up as a demo version and then trialing it. But I think we get a lot of buy-in with that.
Carl, do you want to go next, mate?
Yeah, okay. So I it's funny that you said, Nick, that that's kind of the way you like to learn. So I've signed up for various things over the years, and I go on for the first one, maybe the second one, and then, then I don't bother. I go, oh yeah, I'm way too busy. I can't do that. So for me, I've spoken on this podcast before about the course that I went on that had the most impact on my professional, but also my personal life, to be fair, right? And it was the Munster High Performance Leadership course. And that was a kind of a 3-day intense event whereby there was lots of different modules, lots of different kind of strands to it. And it was absolutely, it was life-changing for me, frankly. So I've been, kind of floating this idea with you guys quite a bit, I would say, that, what about doing this? What about we go to somewhere, I don't know, in the south of Spain, and we get a nice venue and we say, right, we're going to go over there for 3 days and we're going to have an intense workload for the 3 days. We're going to not only do financial planning, you're not only just going to get stuff from us, we might introduce other stuff around it as well. Importantly, the idea here isn't that we're all, going on a boozy trip away. Of course, we will have maybe a final dinner and have a few drinks and wine and kind of have our connection there. But there's real work and intense work so that we can deliver something like I was delivered, whereby we can say, yeah, that people would say, yeah, that changed the way I run my practice, that changed my professional life. That's what I would love to do. Now, obviously, this is a much bigger ticket price, and I don't think this is a mass market kind of thing. I'm thinking, is this 15 people maximum? It's probably, you need that many people to kind of share stories and help each other. I think the community that spends money on this is a community that, like us, that went on the Munster High Performance course, we are still together, still all these years later, bouncing ideas off each other. But this is this an $8,000 kind of a price tag? It could be. That's kind of around what I paid to do the Munster course, and it was the best $8,000 ever. But I didn't have it at the time, so it was like, I clearly did have it, but it stretched our business to send me on that course. So look, it's that's just another idea, but we would need commitment from 10 to 15 people to make this work, and then obviously if it works, we could repeat. So for me, as Alan says, right, and I'll apologize out loud here, that we do get people reaching out all the time. I ignore the vast majority of them. So if you're the one person that I've ignored, or you think you're the one person I've ignored, I ignore everybody because I'm just really, really, really busy. And my commitment is to the podcast. So I give the show, I do my bit of prep work for the show. But if people wanted to get, now this next comment is going to trigger lots of people, because a little bit like SJP, there's people watching SJP just to slag SJP off. There's definitely people listening and watching the Trap podcast just to slag us off, right? So prepare to be triggered, those people, right? If you want to get exclusive access to the four of us for a very short and intense period of time, well, here's an idea that might work. I love the idea of it, and I'll be totally straight up. I love the idea of it because it's 3-4 days I can just mark out of the calendar, say, I'll give it my best. I'll give it 100% for those few days, but then after that, I'm done. The whole idea of doing ongoing content just makes me a little bit nervous, but I'm sure we can schedule that as well. So look, today is just about throwing out some ideas. And if you go on our website, there's a contact us part of the website now. And if you are saying, I am totally in, well then, just put it down there. I think it'd be fair to say I'm probably the only one of the four of us believes that this idea can work. But I do think it can work. And I do think we can add significant value to a small group of people. And I think we can change lives. I really do.
I think a lot has been said already, but I'm just going to mention a couple of points. There's various things that we can do here, and we've got to be careful of not encroaching on other businesses in our space that are already doing this, maybe better than us. So, for example, if you've got an online community, there might be better online communities out there at the moment. If we're going to create content for advisors, there might be better companies out there already. Our real value is, ourselves, our experience, having those conversations. So the online Trap Academy is an obvious one for us to do, and it's not a huge amount of additional work, because the good thing about an online academy community is it sort of compounds. So when we first launch, it will have X amount of content, then we add 2, 3, 4, 5 things, the following month, and that just compounds. So the later and later people join it, let's say, the more content they get. Something else that crops up quite a bit, and I think Alan's working on it, but a jobs board is something that we can look at, because we often get contacted by younger advisors saying, I want to do full fat financial plan. And we get contacted by people that run firms and say, we do full fat financial plan and we need more advisors. That's an obvious, matchmaking service that we need to explore. The other one that is maybe something we could do is paywall podcasts, but we obviously want to keep the 2 that we do each month free for everybody. That's our gift to the community, but we could add further niche certain subjects, 1 or 2 of us chewing the fat about a paywall podcast. But again, it's a little bit tricky to try and do that. Carl's right. If we go away for 2, 3, 4 days and it's a highly priced retreat, it doesn't want to be, let's say, a piss up. But we could introduce trap lunches that are very much light-hearted, maybe 2, 3, 4 of us there, 8 people around a table, 10 people around a table, and it is a bit more relaxed, intentionally, but people sort of know what they're getting. Some people are great at a 3-day retreat. Some people that's hell. Some people are fantastic at lunches. Some people that's hell. So we'll offer, a few different options. Our challenge is there's 4 of us, there's 4 leaders. When there's 4 leaders, there's no leader. However, we're obviously getting slightly better at that. We're giving each one of us, one remit to do one thing. So it is interesting. Yeah, we have been going for about 2 years we've been going for, or is it a lot longer? I'm not losing track of time.
3 years. 66 weeks, so 3 years.
We launched 3 years ago, just over.
Wow, a lot has happened in that time. So it's exciting, yeah. So our first step is our partners, so that we're doing lots of stuff with them. And now, how do we build this out? But we're 4 busy business owners, and we've got lots of stuff bubbling in the background. We obviously give Trap the respect it deserves, but we want to find something that adds the most amount of value that requires the least amount of our work. That's not said in a lazy way. That's just how this podcast.
We want to be the most
effective,
the most
effective with our time.
Which is why we're raising this. This is why this is the meat and potatoes on this episode. In that, as Nick often says, this is for the community, by the community, for the community. This is a symbiotic relationship. We don't just dictate. We ask for feedback constantly from people, and we get it. We get people's we get, as we'll show in a minute, the Trappist questions and what have you. So there's no point in us launching some fantastic product or service. We've got this 3-day intensive mastermind retreat in Spain and no one's interested, like zero.
Sure.
So,
Sure.
and every other version of that, what we do know is that based on our downloads and our numbers, that people are interested. They consume the podcast. The Trap Live is a sellout. We've done it twice. It's a sellout. No doubt when we start promoting that again for next year, we'll sell out a room. So there is demand, but now we're looking at doing something a little bit different, a bit dynamic. So please, as you say, I'd invite anyone who's listening or watching this podcast to go to the website, which is
therealadvisorpod.com.
Is that right, Nick?
With an E, the Real Advisor Podcast with an E.com as an advisor with an E.
Not advisor.
Advisor.
And it's
scroll
just
to
got,
the bottom.
at the moment, I mean, if we had our act together, we'd give sort of a survey or something, but just send a message, please, because we can create, if the market requests it, we can create something that hopefully is valuable to the audience. So please do get in touch once you listen to download.
Valuable and unique. Sorry, that's the key word I want to focus
There's
on.
loads
Unique.
of other
We don't
things
want
out
to do
there.
what everyone else is doing. The other people are doing stuff really well that we don't need to clone that model because it would just be additional for people that are part of both communities.
Well,
so
something
unique.
The differentiator is we're practitioners. To one degree or another, we're all still at the coalface. There is. Don't look at me like that, Nick. I'm still out there. This is not a knack. This is not a never advise the client conference. This is real life experiences, real life stories, raw, honest, whatever you want to do. So please get in touch, drop a message, give us your thoughts. Via the website is the best way to do it. And hopefully we can build something that's valuable for all of us.
Okay, right. We've left that there, really. I think this could easily become an internal dialogue that might be less interesting to our audience. We've given that a good. I think what the ideas we've thrown out there. We'd love to hear your feedback. Do let us know. We're obviously progressing things with Trap. We're not going away, as Andy said. The bi-weekly podcast will remain, provided we haven't killed each other. But we're just looking to do other things, all right? And everyone benefits, all right? Everyone it's win-win is a thing because it does work in the real world. Okay, right. Yeah. What are we at? Jesus Christ, 81 minutes. Shoot me. Let's go on to Trappist questions. There she goes. There's Posty holding the bulging sack of Trappist questions on my drive. If you want to have a question answered, do click on the link, the pinned tweet on X, the pinned X on tweet. There's a link there. You can leave your question in the hopper. We'll get around to it. Also in the so-called show notes, there is a link as well. Let's have a look and see who this one is from. Oh, this letter's been opened before. This letter was opened, was sealed down again with sellotape and resent to us. And we had to pay the postage on this one. And this is from a guy who, in the last episode, we didn't give him quite the respect he deserved. And I'm now going to butcher his name, even though I've been told twice by Connor Cahalan. Cahalan, shit. Connor Cahalan. Sorry, with a very silent E. Connor, get rid of the E. It's pointless.
Cahalan.
Serves no thing. Anyway, Connor's question, which was
6 times.
Connor was the same thing as last week. Hi, how do you all model for later life care and home costs? Do you use any products like lifetime care annuities, or do you just set aside some capital? And if so, how much? I know Andy's going to go on this. I'm quickly going to go on this. It's a pity you're not here, Connor, because I'd love to ask you how you do it. And maybe in the YouTube channel where you left a comment, you could tell us in there how you do it. I would just say the times I've done it, and it hasn't been that great. I have not done as much as Andy has done it. But when I've done it, cash flow has to be integral to it. I mean, at the very worst, at least a spreadsheet. But if you're not, care costs, the unknown, how many years you're going to live against the known, the outlay for the care annuity that's going to fund the care costs, and cash flow with the pretty graphs, right? Picture says 1,000 words, where the lines intersect. Is that, do you think, Mr. and Mrs. Client, or the client, the family of the person going to care, how do you feel about that? Outlay now to cap it here, or we just run with it? But every case is different. It's a very nuanced question, as I'm sure Andy's about to elaborate on.
Carl's going to go next.
Am I? That was not what we agreed. But anyway,
I must get used to these things. That's very slick. Good stuff.
Yeah. No, look, what I would have answered last week, but it was all a little bit all over the place. So what we used to do was at age 85, we turn off indexation on the basis that in a 40-year plan, at 85, you're probably not going to be spending, as much as you had done in your
indexation of expenditure?
Yeah, yes. Flatlining expenses. Yeah. He's been taught by me.
We will do that, and but we will then show. Look, if clients bring up, well, what about long-term care? We go, well, if we turn it back on, we think we have more than catered for it. But to Andy's point last week, which he did mention, for clients in their 40s or 50s doing financial plans and putting in long-term care costs, I don't think it's actually that relevant. But when you start talking with clients who are in their 70s or even late 60s and into 70s, I think it becomes a big part of the discussion at that stage. And I think then at that stage, you just put a number on it. Well, that's what we would do anyway. We'd say, okay, is it going to be, a grand a week? Is it going to be 1,200 a week? Something like that. And you put those numbers in and you give some comfort around it. I suppose the tricky bit is you don't know how long long-term care is going to go on for. So it's kind of hard. But yeah, I think there's lots of different ways that you can do it. But for sure, it's something that when you have more elderly clients, it becomes something you've got to focus in on a lot more, I would say.
Alan, you've raised your hand.
Yeah, well, I thought you were the expert. I didn't think I was going to...
I'm waiting for you guys to just ramble on and then I'm going to close it up.
Waiting for the amateurs to get out of the way so the big dog comes in and
tells
us the real answer.
First.
Right. The data is, Carl, last time I looked at it, the average stay in a care home is 2 years across the country, but more...
2.5 years in council, 3.5 years private.
Right. That's what I'm going to say. 2 years and then 3 years in a private. So you can model that and you can allocate the funds, etc. And the difference is, of course, modeling is one thing. You might be your mum, yourself, your grandmother, whatever, might be the outlier who lives 8 years in the care home. So this is, I mean, the annuities is really for peace of mind, isn't it? That's got to be the thing. You can model your cash flow so you've got enough to more than cover the cost for the next 5 years, let's say. But what if they live to be another 7 years in the care home? Once again, it's an art as well as a science. Over to the expert.
No, we've covered quite a bit. In order to comprehensively answer this question, it will take me a long time, but I'm just going to give some high-level points. So Carl's correct. If you've got 40, 50, 60-year-old client, early 60s, and care home is not a direct issue, then you don't really need to model it. I don't think so for young clients. And also, if they're very high spenders, sometimes clients going to care home, their total cost of life reduces. If you've got a client family that's spending 150 grand a year in the care home, 60 grand with Irish numbers maybe, then obviously their overall cost of living goes down. If they're low spenders, then the care home will have a big impact on it. I've got clients in their sort of early, mid-80s, and care home is going to be a potential issue for health reasons. I do create what-if plans and purchase immediate need care annuities, but I also do a lot of work where someone's actually gone into a care home. I know all the finances, and then we need to build the forecast then. The last three that I've done, the average price of care now, all three of them was 120,000. So the UK now, London, Southeast, we used to say £1,000 a week was a lot. Now we've reached £2,000 a week pretty quickly since we hit 1,000 a week. So it is a huge cost. I believe Connor is based in Northern Ireland. The numbers will be slightly reduced maybe. So again, it does depend on the age of the client, the impact of the care cost, the current assets that they've got. It's an art, not a science, as Alan Smith said. So yeah, good question. Hopefully we've given it a damn good thrashing this week.
Thank you, Connor, for the question.
Thank you, Connor.
Nick,
you're muted, you amateur.
Sorry. Right, geez. Connor, I hope you're happy with that. You got more of an answer than you got last week. Let's move on to Culture Corner.
Yes.
Yeah, barely good.
John Collison has a podcast called The Cheeky Pint. Yeah, it's quite good with some very high-profile guests. But I committed to continually committing to learning about cryptocurrency. He interviews Brian Armstrong, who's the CEO of Coinbase. And one thing I said was, I'll start taking this stuff more seriously when it becomes more mainstream. Well, that's what Coinbase's mission is. It's a really good, it's an hour and a bit, so it's a wide-ranging conversation. You will learn about Coinbase. You will learn a little bit more about cryptocurrency. He's obviously very bullish about it. But you know what? It's kind of there's a startup story there. So the amount of times that people tried to hack Coinbase and get into them at the start, and it was all going a bit, and people succeeded, and they were able to kind of wind back and all that kind of stuff. So it's very interesting. I know Stripe obviously are looking at stablecoin. So then when you learn about a little bit more about Coinbase, this stuff is here to stay. It's going to become more and more part of our normal life, normal financial life. So I would encourage everybody to listen or watch this podcast or YouTube video to learn a little bit more. But these Collison guys, wow, they're geniuses.
They're very impressive. Very
Good
impressive.
old Limerick boys. Cool.
Yeah.
Just on that, I don't know if Alan's got a point on that as well. That is the problem with crypto exchanges. The people trying to get in are the smartest people in computers on planet Earth.
Yeah.
The crypto people are 10 steps ahead of, normal punters. So I can imagine the security levels on the crypto exchanges just getting better and better every single day, because the people trying to get in are the smartest hackers on planet bloody Earth.
Yeah, he does tell a couple of stories, Andy, about that. So it's very interesting stuff, and you're exactly right. You're exactly right.
That's great, Carl. I'm going to check that out. Sounds good.
Yeah, definitely.
I listened to, over the weekend, probably two of the most popular podcasts out there. Number one was Joe Rogan, and the other was Tim Ferriss. So Joe Rogan, once again, had invited Elon Musk back, 3.5 hours long. Whatever you think about Elon Musk, my God, just living and observing him in real time, what he's doing, what he's up to, it is just off the scale. I mean, there's just so many things. It's a long podcast. Listen to it or watch it over a period of time. It's entertaining, wide-ranging. They speak about the UK quite a bit, but they just talk about the technological revolution that he is driving and all his various companies. The one thing he's talking about is when they release the new Tesla Roadster, which is going to be, he said, this year, when this year is almost finished, he said it's going to be the biggest product release, the most mind-blowing product release ever in history. So imagine the iPhone. Imagine every product's ever gone. That, in Elon's opinion, there's a suggestion that it might be able to fly, the new Tesla car. So, yeah, the whole thing is just mind blowing when you listen and watch that. And the other one, on a slightly different tack, in a much more kind of sedate but nevertheless quite impressive and inspiring way, Tim Ferriss, who's a podcast who's been around forever, and he's got nearly 1,000 episodes out there. And he just interviews really good people. And he's just had a conversation with a guy called Jack Canfield. If you guys have come across, famously the author of Chicken Soup for the Soul back in the day, which became one of the biggest bestsellers ever. But it's just the guy. So Jack Canfield is 80 something now. So imagine his whole kind of life story, upbringing, entrepreneurial journey is really quite inspiring, what he did and the hard work that he put in, and his sort of how he got his business off the ground, and sort of how he had to be creative and all these things. It's and that's just over an hour, and I just found it really, really good, very positive and very inspiring. So check out Joe and check out Tim Ferriss. Really good stuff.
Thanks for your 2 recommendations, Alan. Should have been 1, but hey-ho. Right, my one, keep it short and sweet. I listened to the Elon Musk podcast. It is amazing. I mean, it's 3.5 hours long. I wish it was 13.5 hours long. Yeah, awesome. Check it out. Next up, my recommendation is Chris Williamson, Modern Wisdom. Slightly offbeat guest, but he's a UK British rapper or businessman and actor, Bugsy Malone. 2.5 hours long. Again, it is amazing. Really, really, really good. Check it out. Over to you, Nicholas.
Okay, I'll be quick on this because we're way over time, really. My podcast is from the FT Behind the Money series. Quite a good podcast, normally well put together, well researched. Obviously, the FT is still vaguely credible sometimes. And this is about this company called First Brands Group in America, which has collapsed with lots of dodgy finance. But again, it's private involved. This is now private credit as opposed to private markets. But there's a whole swathe of credit being given to companies that, since the financial crisis, couldn't get credit through the more conventional banks. And they've gone to other routes to get it. But the other banks are kind of involved. It's like all these things, there's layer upon layer upon layer. But there are people like Jamie Dimon are talking about this, and people at HSBC talking about this. This could have a ripple effect. Again, I'm not suggesting, I'm not forecasting, but just keep an eye on this because it is a thing. And it's just part of this thing, this whole private thing. It's just, I don't know. Carl, you quite enjoyed this, didn't you?
Yeah, I did. And I love your man Jamie Dimon said, if you see one cockroach, it's likely there are more.
There's more, yeah.
I literally mentioned this and that company on the last episode or a couple of episodes ago. So the FT's
were you on the podcast as well?
I think I was, yeah.
Right, okay, excellent. Okay, well, sorry, you can completely validate my point. Okay, there you go, dear Trappists. Episode 83 of Trap comes to a close and slides down the U-bend of Father Time. Thank you, dear Trappists, for your time. Please do leave reviews and comments, like and subscribe to our YouTube channel. But until the next time, it's adios from me. Take care out there. Adios from the Trap Pack, and we'll see you on the other side. Goodbye.
Bye-bye.
And don't forget to send your suggestions. How long was that? Longer.